So what are some of the other risks that you're looking out for at the moment?
Yeah, well, really in the short term, I think the biggest risk we're looking out for is what could happen in US monetary policy and interest rates. Interest rates are the gravity of markets. Long-term interest rates are the gravity of what values assets in the world. We're in the end of an economic cycle where particularly the US Federal Reserve is starting to tighten interest rates. The market's expectation is we've probably got about another 5 rate rises. That would probably take short-term interest rates to about 3.25%, and it probably means a long-term interest rate would go from about 3 to about 4% in the United States, would be our best guess of what that looks like. We don't think that's really scary for markets. It's pretty much been priced in and been playing out in markets at the moment. But that all depends about the Federal Reserve not having to tighten further than they're expecting. And the big issue out there and the elephant in the room is US inflation and particularly US wages growth. We've been through this economic cycle as the unemployment rates kept coming down, but wages haven't been going up. And economists don't understand it. There are some very long-term secular forces at work why employees are losing their ability to bargain for higher wages. We don't have time to go into all of that, but there are some very real issues. But with the US economy accelerating because of the stimulus, the tax cuts and the other fiscal stimulus being thrown, we're seeing the strongest consumer environment in America than we've seen in over a decade, right at the moment. Is that finally going to get to a point where employees will be demanding more wages as there's fewer and fewer free people in the workforce? It's a 50-50 scenario. You'd expect it, but it hasn't been happening. If that was to happen, we think it's entirely foreseeable that if you've got a spike in wages in America, it would be the expectation the Federal Reserve is going to have to tighten more than they're currently anticipating, and that would not be good for markets. So in the short term, that's the big issue, and I've written in my investor letter that it's foreseeable in those circumstances that we could have a 20 or 30% sudden correction in equity markets where we are at the moment, if that was going to happen. Is it going to happen? Is it not going to happen? I have no idea. I do think in the environment we're in with very low unemployment, with a massive fiscal stimulus occurring in the United States, the probabilities have to be reasonably high. They have to be reasonably high. We're not saying it's more than 50%, but it's not a 2% probability that you could get that circumstance. If it was to occur, it's very foreseeable today. And this is why we're being very cautious at the moment. It's why we've got 18% cash. It's why we've got so few exposures to what we call sort of recession-prone companies at the moment. So, you know, it's kind of how we're thinking. We're not predicting a major market correction, but it's in the viewfinder at the moment.
Thank you very much, Hamish, for joining us today for HUBsights. And if you want to know more about HUBsights, you can visit us at hub24.com.au.